Coach is back.
Fashion always looks to the youngest generation for inspiration, and then every other generation follows. So we knew if we could win with the timeless Gen Z, we can win with everyone.
And in 2024, Coach surpassed Michael Kors to capture second place in the U.S. luxury handbag market. It was named the 5th hottest fashion brand in fourth quarter 2025, climbing 10 spots from its previous ranking. Cosmetics company E.l.f. Beauty has won over makeup lovers from all over, with its low prices, great dupes, and viral marketing.
Are we even surprised at this point? E.l.f. is always killing it.
This product is so good and it is so affordable.
Americans are picking knockoffs as they prioritize price and value, especially Gen Alpha, Gen Z, and millennial consumers who have made E.l.f. their most purchased cosmetic brand, according to the company.
Apparently Gap is a new Aritzia, so of course I had to go check it out myself.
We're actually hearing that Gap is kind of cool again, and we haven't heard that for the greater part of 20 years.
It has excited Wall Street, it's exciting customers. This isn't a total turnaround just yet, but we're witnessing the very early innings of a huge renaissance for one of America's most iconic house of brands.
Coach purses were a staple in the early 2000s, worn by teens at the mall and celebrities on the red carpet. The monogram design with the double C logo was everywhere. But by the 2010s, the brand fell out of favor. Its luxury reputation suffered, and sales plummeted. The company wiped out about 60% from its market cap between its 2012 peak to mid-2014. But Coach is back.
The girls came through. Coach is back.
Mainly among Gen Z consumers who are driving a lot of its growth.
Fashion always looks to the youngest generation for inspiration, and then every other generation follows. So we knew if we could win with the timeless Gen Z, we can win with everyone.
And in 2024, Coach surpassed Michael Kors to capture second place in the U.S. luxury handbag market. It was named the 5th hottest fashion brand in fourth quarter 2025, climbing 10 spots from its previous ranking.
In this sector, it's really rare to take a kind of mediocre mall brand that has been tarnished and then elevate it to be a credible luxury contender. That is very, very rare.
Coach was founded as a men's leather goods business in 1941.
It was inspired by a baseball glove. Over time, a baseball glove's patina is enhanced. It gets better over age. And that's why today you see 10, 20, 30-year-old Coach bags, but across the globe, still having that beautiful, sustained patina.
In the decades that followed, the brand transformed into a women's fashion house, opening its flagship store on Madison Avenue in 1981, and then boutiques in Macy's department stores across the country. The brand distinguished itself as accessible luxury, high craftsmanship at affordable prices. In the late 90s to early 2000s, its iconic logo-covered bags became an it girl item. But as logo mania fell out of favor, Coach suffered. Its heavy discounting and overpresence in outlet malls cheapened its reputation. Consumers traded the brand for competitors Tory Burch, Michael Kors, and Kate Spade.
It kind of had lost some of its cachet, and the brand had kind of almost been diluted in terms of its heritage and the value of the products.
Between January 2012 and January 2015, Coach shares lost 40% of their value.
There was a time when you'd walk in the store and you were just handed a 20% off coupon, and that was a site-wide or a store-wide discount. And over time, that drags down the brand equity of the brand overall.
By 2013, the company recognized the need to course correct. Nearly all of its North American sales are direct to consumer. So Coach had great access to long-term data. The company hired a new executive creative director, Stuart Vevers, who came from high fashion brands Mulberry and Loewe, to introduce a more youthful aesthetic. He shifted Coach away from the heavy logo designs. The company also closed underperforming stores and moved away from discounting.
They, pulled everything back, went completely back to the drawing board and thought, okay, what do we really need to do? And had a very clear plan and message. They also, looked at their products and realized that, yes, we need to scale back. We need to focus on the quality.
The company also made several acquisitions. It bought designer footwear company Stuart Weitzman for $574 million in 2015, and former rival Kate Spade in 2017 for $2.4 billion. That October, it renamed its holding company, Coach Incorporated, to Tapestry.
It wasn't so much a light switch as it was building on a little bit of success to success to success. We focused on fewer ideas, both in product and storytelling. We became very focused on this timeless Gen Z client globally. We stopped telling ourselves some stories that businesses tell themselves, that every business unit, every market is a snowflake. I think those underpinnings and those principles, coupled with culture, make a huge difference.
In 2021, longtime Tapestry executive Todd Kahn took the helm as CEO and president of Coach. The brand's sales grew 16% that year, and 15% from pre-pandemic levels. 74% of Tapestry's revenue that year came from Coach. Over the last 5 years, Tapestry's market cap has expanded by about 140%. Bags like the Brooklyn, Rogue, and Tabby became bestsellers in part because of powerful social media campaigns with influencers and celebrities like Megan Thee Stallion and Lil Nas X. As Y2K fashion came back in style, Coach seized on the moment by leveraging nostalgia. It rebranded older pieces for a new audience and re-released classic designs, and launched bags at different price points to meet demand for every budget.
Should somebody have to save 3 or 4 months of salary to buy a handbag? Is that really the world we think is great? I love the fact that you don't have to do that for Coach, and you don't have to do that across the globe. So that's part of our success.
Coach has also benefited from Gen Z's love for customization. Its brooches and bag charms have been hits. It's also been experimenting with in-store experiences. It launched immersive concept stores called Coach Play to help boost Gen Z visits, and Coach coffee shops. Coach's revenue grew 15% in Q3 2025, compared to the same quarter a year prior. It also outperformed the industry in Europe and China, and achieved a 77.1% gross margin. More than 2/3 of its nearly 900,000 new customers in North America were Gen Z and millennials. The Brooklyn bag was named the hottest product of Q4 2024 by global shopping platform List. Demand for its products overall was up 332% year over year. Coach's sales grew double digits 2 quarters in a row, while, for example, LVMH, the owner of several luxury brands, witnessed declining sales. And the share price of the two companies reflects this difference too.
You're seeing a very clear market share shift where those brands are declining, and they're particularly calling out the affordable luxury consumers. They have said repeatedly that they have not seen any deceleration in the trend year to date in 2025, which is quite surprising given the environment we're in where the consumer is being more cautious.
Coach generates about 60% of its sales in North America, but its international appeal is growing, especially in Asia. It currently has nearly 1,000 stores in 21 countries. Coach is also exposed to some risk. With the rise of social media, small up-and-coming direct-to-consumer brands are encroaching on its territory. Looming tariffs could also impact the brand. More than half of Tapestry's goods are manufactured in Asia. Planned reciprocal tariffs on those imports are as high as 49%. Yet its supply chain is diversified, with no single supplier accounting for more than 10% of production. It has limited its exposure to China.
Based on what we know today, we will be fine. We have relationships for 20, 30 years with our suppliers. We really are involved in every aspect of the process. That helps us navigate these kind of issues.
Long-term, Coach could diversify its offerings to compete with peers. Women's handbags and other accessories account for about 70% of its sales.
I think sometimes brands go too quickly into line extensions and category expansion, and what ends up happening is they go into lower margin categories that are maybe have more fashion risk, more obsolescence risk, And so they end up actually diluting the equity of the brand by doing too many things all at once. So I like that Coach is being slow and measured with this.
We see so much opportunity, and we see that just on the demographics. If you think about next year and for the next 5 years, there will be 25 million women who turn 18 globally, who can, in the markets that we play, who can afford over a $100 handbag. When you just think about that opportunity to bring them into the Coach vote, to have that first bag be a Coach bag, that's tremendous growth. So I don't necessarily need to be great in everything. We like to be great in everything, but we really need to be great in our core categories.
For decades, the Gap defined American fashion. But Gap fell out of vogue. Not too long after its white denim graced the cover of the namesake magazine. Since 2001, the brand has shuttered nearly 2,500 stores, and the stock of its parent company, Gap Inc., significantly underperformed the S&P 500 and competitors like Abercrombie and American Eagle. But the company is trying to turn things around. It's back in the cultural conversation with splashy marketing campaigns, and hiring high-end fashion designer Zac Posen as its creative director.
We did some heavy lifting to build a foundation. Now we're driving really interesting creative on top of that foundation and building relevance for the brand.
And Gen Z is taking notice too.
Apparently Gap is a new Aritzia, so of course I had to go check it out myself.
We're actually hearing that Gap is kind of cool again. And we haven't heard that for the greater part of 20 years.
It has excited Wall Street, it's exciting customers. This isn't a total turnaround just yet, but we're witnessing the very early innings of a huge renaissance for one of America's most iconic house of brands.
So how is Gap trying to reinvent itself? And can it prove to investors that this turnaround isn't just a passing fad?
Gap had 25 stores in 1972. After going public a few years later, its growth soared. By 1999, the brand had over 2,100 stores across the world. It was just a few years later that things started to go downhill.
By the end of the 90s and into the 2000s, a lot of these other retailers were starting to encroach upon Gap's strength and the singular kind of position that they had at that time. The barriers to entry are low. Malls are growing very, very fast. They're looking for new entrants. And, frankly, there were a lot of players and new entrants. Cheap, fast fashion came about.
After its stock price soared in the 1990s, there was a flash of resurgence in 2012 as the company benefited from the skinny jean craze, excitement around international expansion, and investor bullishness for athleisure brand Athleta, which was acquired a few years prior. But that momentum was halted in 2014 after the rollout of an unsuccessful campaign called Dress Normal. It sent sales and the stock price falling yet again.
If the definition of kind of what you stand for is sort of democratic, all-American, it's very nebulous. 1,000 people can come up with 1,000 ideas what that means to them. And so what you end up on the other side of that, through the entire process, design, merchandising, visual merchandising, is kind of a message that's very, very diluted.
For much of the early 2000s, Gap and its sister company, Old Navy, had been generating similar sales. But over the past decade, Old Navy has become the powerhouse of the company, as Gap fell out of favor with consumers, forcing store closures and sales falling by nearly $3 billion.
For many years, Gap has had to rely on promotions and discounts to move product. They make stuff people don't want, they're not doing the right marketing, and so they just discount it into oblivion to be able to actually move product. That's gonna have a huge impact on your margins. It also had become a bloated corporate company, right? And so they've spent a lot of years doing a lot of layoffs, restructuring the business.
Those challenges were felt across the portfolio, including at its namesake brand.
We consolidated our SKUs, we rationalized styles, improved quality dramatically. So all of those things, including some things like reducing costs, which are key to making a business healthy but not fun, those were setting up a foundation for us to layer on a creative renaissance, really, for the brand.
After putting in work to write the balance sheet, the cultural revival of Gap began in 2023. It coincided with Richard Dickson taking the helm as CEO. He came from Mattel and is largely credited for the revival of the Barbie brand.
We're going to continue to operate with discipline against strategic priorities, operational and financial rigor, and that's what's going to enable us to really reinvigorate this incredible portfolio.
And I think that helps you get someone like Zac Posen.
Longtime fashion designer Zac Posen joined as EVP and creative director of Gap Inc. in February 2024. Posen's main focus is on Old Navy, where he leads the design and merchandising for the brand.
Old Navy is the most important part of Gap Inc. It's the largest revenue driver. If Old Navy has a bad day, then it can drag down the entire business. Richard is a marketing guru. You know, marketing is one way to bring back relevancy and one way to generate sales, but you're not going to have sustainable sales if you don't have great product. And that's where Zac has come in.
Having Zac in the building to help attract creative talent, be a brand ambassador, do actual design and access red carpet in a way we've never had access to, or launch Gap Studio. That's all been a layer on that the brand's needed for energy.
The company has leaned into viral celebrity-led advertising campaigns. South African singer-songwriter Tyla, or Australian pop star Troye Sivan dancing in baggy jeans for its denim collection.
We've been in a denim cycle probably for the greater part of, on the 4 to 5 years, which is right in their wheelhouse. It started during COVID, and it's kind of, that kind of wider, baggier leg denim. They actually executed it flawlessly.
When these things are working well, we're getting so much social media attention that just from consumers that are reposting, that are excited, that are doing the dance themselves. That's where a little bit of this magic energy starts to develop.
The company says it's trying to move with the speed of culture. That can be seen firsthand with its recent Parker Posey advertising campaign. The actress saw a resurgence in fame this year after starring in The White Lotus, and now she can be seen right above the Gap in Times Square.
The company also told CNBC that it plans to renovate about 40 of its top stores, but has not shared a timeline for how long that will take.
When you go into stores, you see better lighting, some better refresh for the experience. It's also omni, so online we have improved the experience with video lookbooks, better shots of photography so that we can do a better job of selling the product and having a customer see how a style is really going to look on them.
What's interesting about this partnership is that some of the custom red carpet looks that Posen designed for actors like Timothée Chalamet or Anne Hathaway are actually being sold through its designer line called Gap Studio.
People are talking about Gap again. You look on social media, people are saying this brand is on a comeback. Richard has focused on Gap. That's where the turnaround is really focused at the moment. But when you are a corporation with 4 brands, you got to think bigger than just one brand.
While Gap and Old Navy's same-store sales, meaning sales at its existing locations, have been mostly positive for the past 6 quarters, Banana Republic and Athleta have been far more inconsistent.
It's one of the long-term challenges they've had at Athleta is product acceptance challenges, which is a nice way of saying they made clothes that people don't like. The focus hasn't been as much on Banana and Athleta because turning around Gap and Old Navy are momentous tasks all by themselves. So there's still more work to be done at Athleta and Banana.
Between 2023 and 2024, Gap Inc.'s overall sales grew by about 1%, primarily driven by growth at Old Navy.
The $15 billion isn't that high compared to, it was well over 16 even 10 years ago. So is that good?
The way you should look at it now is on that 1%. They are growing that 1% on the highest gross margins that they have had in the past 20 years. When you finally do grow sales, you want to grow it in an extraordinarily high profit generating and healthy manner.
But there are still challenges ahead. This isn't the first time that Gap has attempted a turnaround. Its short-lived revival in 2013, for one. This time around, the company needs to prove it can sustain this momentum long-term. And it's not helping that this is a particularly challenging time for apparel retailers, who rely on manufacturing overseas. Gap beat Wall Street's earnings expectations in its fiscal first quarter of 2025. But that was overshadowed by other news that spooked investors.
We're going to start with the Gap right now. Shares are plunging. Earnings and revenue beat estimates, but the company warning that new tariffs could impact its business by $100 to $150 million.
Looking at a 2-year stock chart, the company was up about 200% at the end of May. The news surrounding the potential implication of tariffs has since sent the share price tumbling.
We've already mitigated over half of the anticipated impact of tariffs. We've done it through adjustments in sourcing, manufacturing, assortments, and we remain absolutely committed to achieving additional mitigation over time.
A company like Gap that sells clothes, things that we like to have, but we probably have enough in our closet to get us through a tough economic time, this poses a huge challenge for them. They also have a very diversified supply chain, but a lot of that supply chain is in Asia. And if President Donald Trump's reciprocal tariffs remain in effect for those countries, it could have a huge impact on their margins. It could have a huge impact on their price.
When I see the sort of foundation we built, the creative energy we've created with the results we're driving now, that needs to be what our focus is on.
Cosmetics company e.l.f. Beauty has won over makeup lovers from all over with its low prices, great dupes, and viral marketing.
Are we even surprised at this point? e.l.f. is always killing it.
This product is so good and it is so affordable.
e.l.f. just dropped all of these new dupes. We have to try them out.
It's cool, it's hot. It doesn't matter if it's cheap or if it's a dupe. They've kind of transcended that.
e.l.f. is now challenging legacy players like Estee Lauder. And in May 2025, it announced it was acquiring Hailey Bieber's skincare brand, Rhode, in a $1 billion deal.
Rhode was founded in 2022. $1 billion and founded 3 years ago.
Shares popped more than 25% the next day.
I thought the reason why things were so great was because the numbers were great. It's this acquisition that you made, which everybody seemed to know as being the right thing at the right time.
e.l.f. stock has been volatile over the past 3 years. But the company posted its first billion-dollar year in May 2024 after sales spiked 77%.
Last 3 years, our stock is up over 200%. So we continue to be able to prove people wrong. And part of that has to do with our ability to execute and the strong growth that we drive. And we have incredible white space ahead of us.
It really is in a league of its own. And we do view e.l.f. as a best-in-class executor.
And while the company reported its 26th straight quarter of net sales growth, in its Q1 2026 earnings on August 6, 2025, it faces some challenges ahead. A weary Wall Street that believes the company could be peaking. Its stock fell more than 10% on August 7th. Its heavy reliance on China caused profits to drop 30% in that first quarter. And it has a heavy debt load from its Rhode deal.
That's the reason for the swing, right? Is I think they could feel a bit of the slip. They'd gotten there and have done a really nice job, and then have felt these headwinds. And if you were to ask me, are they going to be bigger or smaller in 5 years? I would guess bigger.
So how did it get here? And will its $1 billion bet on a mere 3-year-old viral celebrity makeup brand pay off? e.l.f., which stands for Eyes, Lips, Face, was founded in 2004 in Oakland, California. It initially sold just 13 affordable quality makeup products online. Within 3 years, the company grew into a multi-million-dollar company, developing dozens more products and partnering with retailers like Target. It opened its own stores in 2013. CEO Tarang Amin, who joined the company in 2014, brought a wealth of experience working with consumer product companies like Procter & Gamble. He wanted e.l.f. to become even more accessible.
We want to be wherever our consumers are shopping for beauty. e.l.f. is a very elastic brand. Same quarter, we launched into Dollar General. We launched into Sephora, Mexico.
Also in 2014, e.l.f. expanded its reach by selling internationally in the UK and Canada. It went public in September 2016, raising $141 million.
The two most important things that have fueled e.l.f.'s strategy is marketing and its ability to offer dupes of some very popular prestige products at bargain prices. Shoppers actually asked e.l.f., please create a dupe of the drunk elephant. They're not actually comparing the products themselves. They won't say that publicly, but the consumer does that for them.
Selling dupes, or cheaper yet premium versions of popular makeup products, has been a part of e.l.f.'s business model since the beginning. But it has especially benefited with the acceleration of dupe culture over the past few years. Americans are picking knockoffs as they prioritize price and value, especially Gen Alpha, Gen Z, and millennial consumers who have made e.l.f. their most purchased cosmetic brand, according to the company.
We don't make dupes. What we take is we take inspiration from what our community wants and the best products in prestige. We always put an e.l.f. twist on it so it's different and at a much better value. So the real innovation here is how you get that prestige quality at the incredible values we're able to.
e.l.f.'s digital presence dates back to its early roots as an online-only retailer. Its advertising strategies have helped it win over consumers from a variety of demographics. It advertises on online gaming platform Roblox, was an early adopter of TikTok, and had a Super Bowl halftime commercial with Jennifer Coolidge in 2023.
Oh my goodness, I look like a baby dolphin.
All the user-generated content of people sharing like side by side of the Dior lip oil and the e.l.f. lip oil. This is free marketing for them constantly.
Honestly, they look basically identical.
The company adapts and creates new products based on customer feedback, which it closely monitors on social media.
They're paying attention to what shoppers are asking for. They could post an ad about this new product and people be like, I tried it, it was too sticky, or the lip oil is drying, and the company will actually go back and make the lip oil more hydrating. So keeping that really close pulse on the consumer is what e.l.f. has said has made it so successful.
The company has also been quick to course correct. For example, in 2019, the company was fined $1 million for inadvertently importing materials from sanctioned North Korea. The next month, Amin closed all 22 of e.l.f.'s stores, saying it was to focus more on growing the company's presence in national retailers and digital channels. And in May of that year, the first Trump administration increased tariffs on Chinese goods from 10% to 25%. At the time, e.l.f. sourced 100% of its products there, so the company started shifting production away from China.
The way we went from 100% production in China to 75% has less to do with tariffs and more to do with having a well-diversified supply chain. Our preferred approach is we tend to find like-minded suppliers where our quality people on their facilities, our lean manufacturing techniques are there so we can replicate the exact same model in other geographies.
While these events put some pressure on the stock, the company had an overall strong year. Beauty was a fast-growing segment and meant high turnover in terms of inventory, benefiting e.l.f. Its stock grew more than 261% between January 2019 and January 2022.
Wall Street started taking e.l.f. more seriously coming out of the pandemic when beauty was surging, actually, especially in mass beauty where e.l.f. was disrupting the cosmetics space. It was really post-COVID where we did see the greatest benefits for e.l.f.
Its share price nearly quadrupled from 2023 to hit a peak in March 2024, though it has since nearly halved. In that time, it acquired Canadian skincare company Naturium for $355 million and started selling its products in Dollar General stores. But after several quarters of outsized growth that began in 2023, investors grew concerned as sales slowed. The threat of tariffs was another major concern. e.l.f.'s share price declined almost 70% between July 2024 and April 2025.
We're not worried about any short-term stock reaction. I've been CEO 11.5 years. We've seen our stock go from $8 to $220 and everything in between. For us, it's about the long term, and we feel that this consistency of our delivery, in the end of the day, is the most important thing, and people always come around.
They were stuck in the mud for a year after being a rocket ship for so long, so they were looking around and saying, okay, what do we do to shake free again and to get moving? This is a world where you got to just keep kind of innovating.
e.l.f. has been an outperformer in the beauty industry, while legacy players such as Estee Lauder and L'Oreal have reported weaker sales since June 2022. The e.l.f. brand was the #1 color cosmetics brand by units sold and #2 by dollar share in 2024.
We do think that over time, they will eventually be the #1 mass cosmetics company globally.
In e.l.f.'s full fiscal year 2025 earnings, released in May, the company grew net sales by 28% to $1.3 billion. Its international sales also grew 28%, driven by expanding into new markets like Germany, Belgium, and Poland. In its fiscal Q1 2026 earnings, e.l.f. reported higher net sales growth, though net income declined substantially.
Certainly tariffs are a factor right now, and we take a long-term view and have real responsibility for ensuring proper consumer value. And so that impacted, obviously, the gross margin line, but overall, we had very strong results, including 12% adjusted EBITDA growth, even in the face of tariffs.
E.l.f. has stolen the spotlight because the shares are up 25% after they spent $1 billion to acquire Hailey Bieber's company. It's called Rhode.
The Rhode deal, announced the same day as earnings, surprised some experts.
We kind of, from the M&A advisory world, assumed, hey, they have to be heads down and focused on the supply chain, the stock. I cannot imagine they're going to take a big swing.
We've been tracking Rhode for a long time. We're always attracted to other disruptors, and what Hailey Bieber and her team have done is nothing short of remarkable.
With just 10 products, Hailey Bieber's direct-to-consumer brand grew to $212 million in net sales in a mere 3 years. It has more than doubled its customer base over fiscal year 2025 and became the #1 skincare brand in earned media value, which is an estimate on the performance of a company's non-paid advertising, like social media mentions, reviews, or media coverage.
It's a very impressive ramp, being about 3 years old at this point. We're more excited about E.l.f.'s ability to help Rhode expand distribution beyond that Sephora agreement, both domestically and internationally.
E.l.f. was already on the map. We launched in Sephora with the E.l.f. brand last year in Mexico. It was one of the best launches they'd ever seen. We loved what we saw. And so certainly this broadens our partnership with Sephora by going into all US and Canadian doors.
The acquisition is E.l.f.'s biggest ever. It financed the deal with $600 million of debt.
It was either get that debt or you're not going to get this deal. I think there's a very good chance that this turns out to be pretty heavily accretive. Through that lens, I like them getting scrappy and figuring it out.
There's a lot of what ifs. You look at Selena Gomez, you look at Kylie Jenner, some of the beauty brands that they have, really strong performers. How long does that last? But there's certainly questions that Wall Street's going to be asking as this company continues to grow.
E.l.f. is exposed to tariffs given its heavy reliance on China. Today, 75% of its products are sourced there. If unchanged, E.l.f. expects its cost of goods sold to increase by at least $50 million annually. And the new tariffs cause net income and profits to each fall 30%. However, the company is working on lowering its dependence on China even more, exploring options in Thailand and parts of Europe. But that'll take time. Rhode sources primarily from Europe and South Korea. E.l.f. raised prices by $1 on August 1st, but said the adjustment won't mitigate any impacts until its second quarter. It's the second time the company has raised prices since 2022.
75% of our products are still going to be $10 or under. We're doing more supply chain optimization and business diversification. 2/3 of Americans live paycheck to paycheck. We actually think it's immoral to charge them so much money for products that we clearly can make for a fraction of that price.
E.l.f. is one of the most exposed consumer companies when it comes to China tariffs. Now it's $2 in the last 5 years or so. Is that going to be the thing that tips the consumer over? If you have a good enough product that is that well performing and that much cheaper than the prestige equivalent, then my gut tells me consumers are still going to shop and buy it. But a lot of that comes down to whether or not the product's worth it. So far, consumers have said that E.l.f.'s products are worth it.